Hi everyone, welcome to Money Finesse Mindset Episode 3. Imagine this, you are a credit card issuer, a landlord, and a loan officer all at once. This morning, 4 strangers came to see you. Person A wants your new credit cards. Person B is applying for a car loan. Person C hopes to rent a place you own, and the person D needs a mortgage. You are willing to make deals, but you need a way to assess their risk. After all, you can't just give things away. So, how do you figure out who's good for it? Well, you check their credit scores, of course. If you have ever used credit, you probably have a credit score. This 3-digit number sums up how well you keep up with payments. It's essentially the grade on your borrowing report card. Most of the time, you won't even think about it until it gets in your way. Need a loan? A low credit score can get you rejected or stuck with high interest rates. Like it or not, your credit score follows you everywhere, and if you neglect it, it hits back. There are 2 main credit scores, FICO and Vantage. FICO is the OG, becoming popular with creditors in the late 80s. Vantage came along in 2006, a latecomer but a strong competitor. I will not dive into all the details of how they are scored, but just remember this, aim high. Let's talk about FICO first. It ranges from 300 to 850 and falls into 5 categories: poor, fair, good, very good, and excellent. For example, if your FICO is 825, congrats, you are in the green zone of excellence. If it is 375, you need to do something about it. Vantage works similarly, also ranging from 300 to 850, but the cutoff points for the 5 categories are different. For example, FICO generally considers 800 or higher excellent, while Vantage often use 781 as a benchmark. Although both FICO and Vantage usually move in the same direction, they don't always land in the same category. So where do these scoring models get their data? To answer that, you need to know a thing or two about credit reports. A credit report has 4 parts: personal information, credit inquiries, credit accounts, and public records and collections. Let's break them down. Personal information is the only section that doesn't affect your credit scores, but you should still check it for accuracy. Credit inquiries can be a bit tricky. It all comes down to this question: are you applying for new credit? If you are, your request gets logged as a hard inquiry. Hard inquiries can lower your credit scores, usually by a few points, but their impact fades over time. If you are shopping around for the same type of loan, like a car loan or a mortgage, multiple inquiries made within a short period are usually grouped together to minimize the damage. So why do hard inquiries hurt your credit scores? Well, they can signal you are already facing a financial gap or you are about to create one, which is concerning. On the flip side, if you are not the one making the inquiry, it's called a soft inquiry. For example, let's say you have a Chase credit card. Chase may pull a soft inquiry to check on you. After all, while they know how timely your payments are with them, they don't know how you are doing with other creditors. Since Chase is the one making the inquiry, this information is visible only to you, and your credit scores won't be affected. Credit accounts, or trade lines as they are commonly known, are like short stories. Each one tells a tale about how you manage credit. The typical trade lines you will see on a credit report are credit cards, loans, and mortgages. However, some types may only appear when they go unpaid and are sent to collections. For example, utility bills, medical bills, buy now pay later arrangements, and rent payments usually won't show up on your credit reports until you fall behind on them. When I check a trade line, the first things I look at are the balance and the credit limit. The balance is how much you currently owe, while the credit limit is the most a creditor allows you to spend. If you divide the balance by the credit limit, you get a utilization rate. For example, if one of your credit cards has a balance of $5,000 and a credit limit of $10,000, the utilization rate on that trade line is 50%. Here's why that matters. The general rule of thumb recommends keeping utilization rates under 30%, but lower is always better. A high utilization rate makes you look financially stretched, which can drag down your credit scores. Next up, payment history. Want to know how reliable someone is with payments? That's where payment history comes in. Then there's account status, which shows your standing with a creditor. If you are making payments on time, it will say current. But if you are more than 30 days late, your creditors may start reporting it as past due or delinquent to the credit bureaus. Late payments typically appear in 30-day increments, like 30 days past due, 60 days past due, and so on. At some point, usually after crossing the 180-day mark, the creditor will charge off the debt, writing it off as a loss. But that doesn't mean you're off the hook. A charge-off is just an accounting move. It doesn't erase your debt. Here's the thing. If your trade lines are past due or charged off, your credit scores take a hit. On top of that, debt collectors will start sending letters, calling, texting, and emailing. So what should you do if that happens? Well, that's a topic for another episode. Public records and collections. This final part of a credit report is not fun to look at. If you are drowning in debt, bankruptcy might be an option, but it's a long, expensive process. And contrary to what many people believe, it doesn't wipe out all your debts. I will dive deeper into this topic in a future episode. If you have trade lines that are past due or charged off, they may show up again here. So you see, this part is nothing but bad news. Now that we have covered the basics of credit reports and credit scores, let's talk about where you can get them. Equifax, Experian, and TransUnion are the 3 national credit bureaus in the US. By law, you are entitled to a free credit report from each of them. Just go to annualcreditreport.com to request them. You can also visit their individual websites to view your credit reports free of charge more frequently. I will include all the links in the description. If you spot something wrong in your credit reports, file a dispute with the credit bureau that issued it. If the mistake is confirmed, they will fix it. Another important reason to check your credit reports regularly is to catch early signs of identity theft. If you see unfamiliar trade lines or inquiries in your credit reports, contact one of the 3 credit bureaus to place a fraud alert, and they will notify the other 2. A fraud alert makes it harder for the thieves to open new accounts in your name, but you may still need to take additional steps to clean up the mess. That's why checking your credit reports at least once a year is so important. It only takes a few minutes, but can save you from a financial nightmare down the road. You might not see your credit scores in these free reports, but there are several ways to get them without paying. For example, many credit card companies let you view your credit scores for free. It's worth noting that while all 3 credit bureaus offer credit monitoring services, they usually come with a fee. So weigh the cost against the benefit before signing up. One final note, your credit scores reflect how well you handle payments, not how well you manage money. You could have fantastic credit scores, yet still live paycheck to paycheck with little to no retirement savings. At the end of the day, good money habits like budgeting, saving, and prudent investing matter just as much as maintaining high credit scores. I hope you find this episode helpful. Don't forget to like, share, and subscribe. Have questions or comments? Drop them below. See you again soon.